my concern is that the market is expecting a hike now because that's what data indicates. But if you look closely, that's not what the data says at all. And I think you and I here, believing that most of inflation is behind us, we're still in the minority camp for that.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to the Bull of Wall Street. My name's Talley. I'm the Chief Market Strategist at the Wealth Consulting Group. I'm joined with my partner, Jim Worden, our CIO. And it is our very great pleasure to welcome Hardika Singh, economic strategist at Fundstrat. Hardika, welcome to the show.
Thanks so much for having me.
Well, look, I know you've got a hard job, so we're going to take it easy on you. We can have a really nice conversation about markets and all of the above. But so nice to reconnect with Fundstrat here virtually. And I guess I'll kick things off. I haven't spoken to Tom in a long time, but hopefully this is going to go great and he'll be pleased. So will Jimmy. I think Jimmy's going to be very happy that you're on the show.
I hope so too. Yeah, Jimmy and I met when I was a reporter. So we go back, It's great to know that we're connecting now years later.
100%. Well, that's a great segue, Hardika. So you've been a reporter at the Wall Street Journal and Bloomberg, and it seems to me that uniquely allows you to fit in the ongoing research agenda and help them kind of elevate the views and the work that they're doing at Fundstrat. But I don't want to put words in your mouth. I wanted to ask you, given your background in journalism, what are some of the things that you had to unlearn, and what are the things that you had to learn in your current role?
That's such a good question. I think the biggest thing I had to unlearn for my current role is dumbing it way down. Because when you're writing for the Wall Street Journal, you are trying to dumb it down. Your goal, your objective, your mandate is to make the mom and pop investor understand. The audience is my grandma who is potentially 75 and trying to understand why gold price is moving matters for her portfolio. So you have to be able to explain the dynamics of global government bond yields to her in a way that makes sense for her. Absolutely. But then when I joined Fundstrat, I think I realized that retail investors are really smart and we don't give them enough credit for that. And the past few years have really made that abundantly clear to all of us that they're incredibly smart, possibly even smarter than me and us all, I would say. So that's the biggest thing I had to unlearn.
Well, it's a great point. And, I've had friends who were on the institutional side of the business, like myself, that left and went into wealth management. And they're some of the most sophisticated investors that I speak with. And so I think you're right. We don't give the typical retail advisor or investor enough credit. So kudos to you for that.
Yeah, it's really fun because when I was at the Wall Street Journal, sometimes we would have conversations with retail investors who were playing with naked put options, right? And I think the typical takeaway from that was retail investors are eager to take on risks that they don't understand. And it was typically a story centered toward making fun of them. But as I've stepped away from that type of role, I'm like, whoa, look at these people who are eager to take risk in a way that empowers their portfolios and they want a better future for their family. And they actually do understand how the derivatives markets work really, really well. So I think that's the point of these markets, right? You want to have a greater number of participants in it so they're more efficient. And I think that we should celebrate that.
Yeah, no, that's another great point. And you learn. We've Jim and I, we've got a few years on you, but he's got more
Just a
gray hair.
few,
I don't have any. I have less
like
hair.
5 years.
But we learn to do a better job of talking to a broader audience and kind of trying to find the common denominator and adjusting our language. Plain, good old fashioned English, I think goes a very long way. But I wanted to ask you because, and correct me if I'm wrong, but I think I saw in your background that you actually used to cover central banks. Is that right?
I used to write the central banking pro newsletter for the Wall Street Journal. So it was
Awesome.
a little bit of writing, a little bit of news gathering, all sorts of stuff.
Yeah. Well, so I'll kick this one over to you. I'm kind of dying to ask you because of that experience. And this gets to the new Warsh Fed. Now, again, I'll just talk for myself. I've always been a believer and an advocate of more information and more communication. So I want to get your thoughts on that, the kind of pulling of forward guidance. What if you think that's a good or bad thing. But I also so that it's kind of pros and cons, right? I also think that on the other side, being more data dependent is probably a good thing. But again, I don't want to lead the witness. What are your thoughts on all that?
That's you said at the beginning of the conversation you'd only ask easy questions. So I'm joking. I'm joking. So I have a lot of thoughts on this actually. I don't think it's a good thing to pull away forward guidance. And the reason why is because, yes, he says he's going to be data dependent,
Mm,
but what is that data that he's going to look at? I think at one point he floated looking at trimmed mean averages for
right.
inflation,
Mm,
which was really concerning to me because you can't just pull out the biggest volatile components from it and say that, oh, the underlying looks great. We don't need to worry about inflation. Let's go ahead
mm,
and cut rates, which we understand is his mandate. Now, I think that most of the time we have seen in the history of the modern Fed, we have seen forward guidance play a large role on how the stock market does. And I think when you take away such a big source of certainty for the market, it is only going to create more volatility. And that's why I think bond yields have risen. I know he's made comments in recent weeks that sort of indicate that bond yields have gone up because of potential growth expectations. I just don't think that's the case. I think they're going up because investors don't trust the move that he's going to make. And then at this second point is that he's getting bullied by economists and investors alike right now to raise rates. He's
right.
facing a lot of pressure. And at the same time, we have no forward guidance. Just looking at the most recent jobs report, I think even after we got this week jobs report, expectations for a rate hike in September haven't really gone down all that much. And I think it's because investors are just really unsure of what's going to happen. Nobody understands it. And I think we still have 40% odds of a rate hike in September. That's too high. I don't think the data indicates right now that we should go for a hike.
I
I don't
agree
know.
with you.
I was going to ask you guys as well. Do you think this is the type of inflation that can even be tackled with rate hikes? That's the big thing that I'm debating right now. I don't
No.
think it is, but I'm curious
Yeah.
about your thoughts as well.
Well, so I mean, I kind of jumped to the chase there, but this is classic warflation, right? We've got headline heat, but we've got importantly core coolness, and raising rates is not going to ease, supply chain disruptions or bottlenecks or open
No,
the Strait of Hormuz. And so when we look, talking about being data dependent, but when we look at economy wide capacity utilization, uh, the economy is not overheating, right? And
no.
that's the real underlying signal here. Not to get distracted by transitory supply shocks, but
Or one
it's
time.
right. Yeah, exactly. We got to look as policymakers, and I don't like to be prescriptive because I'm not a policymaker, but I do have a degree in financial economics, so I know a little bit about it. So when we look at that compared to underlying core inflation, I think inflation underlying trends are right about where they should be. But I wanted to come back to what you were saying, and I've never been in the camp of don't fight the Fed, and you illustrated that perfectly. It's don't fight the bond market, right?
No.
So I wanted to ask you, and I want to get Jim in here too after this follow-up question. But is the Fed being data dependent or is it market dependent right here?
That's such a difficult question. I think at this moment, it is a healthy mix of both right now. And my hope is that Jackson Hole can give us some more insight into it. But so far, what I'm seeing is that Warsh is saying he's data dependent, but at the same time, I think he is scared of what the market is thinking because we have seen yields on longer dated bonds move up. The 30-year is above 5% or close to 5%. And that's worrisome for him, especially because his job is to bring the short dated yields come down, right? And I don't know if that's happening anytime soon because there's such a reputation risk involved with him.
Hardika, I've got a question on just looking at the rates. We were looking at this the other day. We had our investment call with all of our advisors, and it's pretty dramatic, the shift in rates from just 6 months ago, right? And it's across the whole curve, really, except for the very, very front end hasn't changed much, but everything else has changed. Do you see that as more, hey, we're worried that energy prices, because we still have this war going on, and that's going to flow through to core prices? Is it more of a worry of that, or is it more of a worry of, look, all these big companies are spending a ton of money, the capex is off the charts, and there's more of a concern of maybe we do get a little bit too hot with the spending, or is it a combination of both? What's your take?
It's a combination of both, I would say. And yeah, I have been surprised at the steepening, especially because when we entered the year, nobody was thinking about hikes. I'm sure you all remember that. And then the war came and it just turned the whole game upside down. It was so unfortunate because it looked like we were on such a good path for the economy. But if you look at inflation, core CPI, some of the biggest contributors to it since the pandemic, they are shelter, airfare, apparel, recreation and household furnishings. And 3 of these aren't even credit sensitive. So my concern is that the market is expecting a hike now because that's what data indicates. But if you look closely, that's not what the data says at all. And I think you and I here, believing that most of inflation is behind us, we're still in the minority camp for that. We are not in the majority camp. Most of the market does think that inflation is going to become a big problem, and it is going to flow into services more so. Now, going back to the hyperscalers point, that's been surprising to me because if you look at prices on some of the bonds Google offered earlier this year, they've really started to come down now. And it's to me a sign of weakening strength for Google and these hyperscalers, saying that the market has a limit potentially to how much debt these hyperscalers are going to tap into to fuel their capex. And I think the news that we saw this week with NVIDIA's potential 500 billion AI financing, the lack of clarity with that, to me, that just doesn't change anything. Getting money for financing this AI build out has never been the problem. The problem is the backlog right now in memory and storage, which doesn't seem to be going away, even if we have more money chasing fewer goods.
Yeah.
Can I ask a follow-up question on that? And it's related. Sorry, Jim, to jump in. When we're thinking about this huge investment trend, AI, Mag 7, the hyperscalers, as you mentioned, semiconductors, memory stocks, all of that, all the above. Could the semiconductor wave here, just we'll call it AI in general.
Okay.
Could it be telling us something about the broader economy that the traditional economic data haven't really caught up with yet?
I think it has just fueled this divergence in the K-shaped economy. Those who
Mm,
work at OpenAI, Anthropic, they are benefiting from it. But we also have this segment of workers who haven't been able to participate in all the fortunes being reaped right now in this AI boom, right? If you look at the number of jobs in residential activity, workers for residential activity versus non-residential activity, there's a clear divide there. So you
mm,
have uh, jobs needed for building data centers, but you don't necessarily have jobs being created for building homes. And where's the shortage right now? In the residential aspect. So I think it just makes this K-shaped economy even wider. And
mm.
that to me is concerning, but not all that much. Because if you think about it, the top income consumer is still pretty strong. They have been able to benefit from the stock market record that we've seen. And what are the chances that we see another repeat of '08? Because we have such great backstops now in place. The central bank will probably come in to help. We have big banks now too with like great balance sheets. So the chances of that go down a lot. But at the same time, it does feel like we don't have the economy participating evenly and uniformly in this boom. And I think that if we don't have that, economy is going to continue to be in a tough spot. The stock market's push up to records is always going to continue to be jagged. It's not going to be a uniform path up.
Hardika, do you think that the Fed should be more concerned with the lower K? I mean, a lot of these people are really struggling, and I know Jerome Powell was concerned when we did have that bout of inflation. He was worried that, hey, look, inflation hurts these people more than a
Yes.
recession does, and so that's why we have to hike. Now, I'm not so concerned about the inflation part, but they're struggling. Home prices are high. They have a lot of student loans. I feel like the Fed should take more of an approach of, hey, let's be more easy for longer to help these people. But I don't know what your feeling is on that, because it's pretty divided. I think, people think that, oh, the economy's too hot, we need to hike, but I feel like we should give that piece a little bit more attention.
Yeah, hot for basically one segment, the top 10%. The rest, no. I saw Cleveland Fed's Beth's post on LinkedIn the other day where she was giving very specific anecdotal examples of companies and small businesses that are struggling with inflation. I think she mentioned an ice cream shop in Sandusky, Ohio. I'm from Ohio, so I'm invested in the fortunes of Ohio.
Yeah.
And it was surprising to me that she was pointing out to insurance prices for this ice cream shop in Sandusky, Ohio, and then input prices for another company. But at the same time, if you take a step back, yes, they're getting affected by inflation. But at the same time, if you hike rates, they're going to get affected by it anyway. Premiums are going to go up for insurances anyway with rate hikes. So
Yeah.
I just don't see how it solves the problem. Jerome Powell was obviously very invested in what happens to Main Street. And I know when Warsh came on the scene, he also said that when we have monetary policy easing, and it benefits Wall Street more than Main Street. And I thought that was a great point he made. And I want to talk more about this too. But I do
Sure.
think that quantitative easing and the combination of monetary policy setting, I think over the past 10 years, it has disproportionately made the lives of Wall Street better than Main Street. And we can go more into this, but I do think that all those op-ed pieces he wrote in the Wall Street Journal that were obnoxiously long had a point where he said that, if we keep QE going, then it's putting more money in banks' pockets and
Yeah.
investors' pockets. But then we have tightened monetary policy, and that's making lives difficult for people in Sandusky,
For
Ohio.
small businesses and for the lower K, right?
Yeah, because they don't get to benefit from QE as much.
Yeah.
It's not a direct impact anyway. Maybe indirect, we can like draw out conclusions from it, but I don't see a
Sure.
direct impact.
So you mentioned Wall Street. This is a little bit different, but I wanted to kind of hone in on that. This is a question. I guess it puts a bow on some of the stuff that we talked about, but this is kind of Wall Street sell side consensus versus journalism. So kind of tying all of our backgrounds together. So one thing that I appreciate, I've been on the buy side now for over a decade, but generally in our roles as strategists, and I'm thinking back, remembering back to my time on the other side, the sell side, where you are now. I always felt like I was at risk of being trapped in my own hall of mirrors when it came to my views. And, you establish your view. I mean, even now to a degree, right? I got my 10 reasons why I'm bullish, and you're going to defend that view until, the dust settles at the end of the year on December 31st at 4 p.m. But it seems to me like Jim and I, we talk to a lot of different people, and not just on this podcast, that disagree, right? And I think that's very, very healthy, right? It's kind of the market clearing process, right? And it can either get you to think about your views more or can confirm them. And I think it's just a healthy process. But it seems to me that in your current role and your background as a journalist, because you did the same thing, right? You would talk to all sorts of different people that disagreed with one another.
Like Jimmy.
Yeah. I remember that. How do you deliberately protect yourself from groupthink? That's the question. Very long-winded. I apologize.
No, I love it. And it's actually so funny you say that, defending your thesis, because when I first started at Fundstrat, there's no editors, right? You are in charge of publishing your own things and own thoughts. And that is such a complete U-turn from the Wall Street Journal, where I had 6 editors. And I think the first 6 months, I just kept asking every strategist I met, hey, do you all just hit publish on your thoughts and just go for it? And they're like, yep, that's what we do. We don't have anybody look at it. But I think it makes you such a good thinker, right? It allows you to have that freedom because you're not looking to please your direct editor, for example. Right. And at the same time, it forces you to triple check your work because you have no editor. So you don't want to come across looking stupid for missing something that was obvious in hindsight. But I think my best way to avoid groupthink is to talk to a lot of people and try to figure out what they're thinking. And then in my head, try to pitch it to my editors at the Wall Street Journal and try to imagine what their response would be and what areas would they ask me to do more reporting on. And it has really helped me take a 30,000 feet view of topics. For example, and I talk about this all the time, if small caps are going up or down, it's not a story about the Russell 2000. It's a story about what's happening to the broader economy because they make most of their money domestically. So what happens to them is a signal into the broader economy as well. And they move ahead of the broader market, they fall ahead of the broader market. So I think it really allows me to have this holistic view of market forces rather than talking about something, not really knowing its meaning and just saying what everybody else is saying. That and also the fact that people are paying to read our stuff really forces me to write an opinion that's not the consensus. Yeah. You need to have a very clear take. Otherwise, people are going to come back and ask you, why are you writing the same thing as everyone else?
Right.
So I've got a question to follow up on that. Your background as a reporter, I feel like that's a unique skill set going into your role now. And what I mean by that is there's a lot of really, really great economists that are out there. And, what is the joke? You get 2 economists in a room, you may get 3 or 4 opinions or something like that.
Yes.
But one of the challenges I think some folks have, and they could be really, really smart, really, really respected, is that sometimes they're so anchored into their own thinking, their own model, and this is going to happen, that they don't take the other side. But as a reporter, you're kind of in that position to require yourself to play devil's advocate and to talk to multiple sides, and then kind of go from there, form your own opinion. Is that something that's kind of helped you? And
Yes.
does that bring some value? And also, as you're comparing yourselves with some of these other people that maybe you've got a lot more tenure, they've been in the business a lot longer, you can kind of say, well, what am I getting wrong? What am I getting right? Am I missing something?
100%. I think it surprises me how stodgy the thinking can be for some economists, where they are so reliant on how things have played out in the past to illustrate what's going to happen in the future. And that's a flawed thinking, because at what point in the past 5 years has anything gone according to plan? Nothing has worked out the way it was supposed to.
Yeah.
So I think that's why so many of them got caught on the offsides, because they weren't willing to change their thinking. And I think that being a reporter has really, like in the past, has allowed me to have a more open-minded view on these things, because I know anything can happen. I grew up with this mindset now in workforce that whatever you think is going to happen, there's a very good chance it doesn't happen.
It doesn't happen.
Yeah. And again, going back to just this year, who thought rate hikes could be on the table after what happened last year? It's just a complete surprise. So, and that's actually a good segue into something I want to discuss with you as well. So I want to get your thoughts on SpaceX. I'm sure you've been talking to a lot of people about this, but if you look at it, it's a very unprofitable company. Grandiose ideas that have a history of not coming through, given the chief executive. But do you think there's still a reason to buy shares of companies like this that are very ambitious, moonshot ambitions, and we potentially have OpenAI and Anthropic as well this year with their IPOs?
You want to take that one first, Jim?
Yeah, I'll take that one. So you're asking about OpenAI and Anthropic?
And SpaceX too.
And SpaceX?
I want to understand how you're viewing these.
So, I mean, we bought into, full disclosure, some of our models bought into SpaceX. This was not hey, we think it's going to go straight up. This is a long-term thematic play on optionality for orbital data centers. It's, optionality for what they do with Spectrum and Starlink. And so not knowing, just because there's more shares, that more supply that comes online. And so, but that's very, for me at least, looking at that's very thematic. That's very contained within a small part of the portfolio. It's not, hey, we're going all in on this.
Yeah.
I have different feelings when it comes to OpenAI and Anthropic, leaning a little bit more toward one over the other, but it goes back to how sustainable is this and how much money is going to eventually get in there. But it's a long-term thesis for me, just because we don't know. I mean, it is wild when you peel back the onion, when you look at Google's you look at Google's report. They reported more than $9 a share, and I think the street was looking for like $2 and change. So that's a big delta. And then when you look at the footnotes, more than $6 was related to investments in SpaceX and Anthropic. That's a lot, but some of that was due to valuation. And so you have to take some of these things, I think, with a grain of salt. Microsoft's accounting is a little bit different, but they actually made more money from Anthropic than OpenAI, and they were a bigger investor in OpenAI. So I think at the end of the day, we have to look at the numbers. We have to see what the trends are. I'm, in addition to a CFA, I'm a CMT. And so I have to look at the charts and to see, are there trends? But I think at least for those areas, the way my view is that I think thematically they're really interesting, but I still tend to like the picks and shovels, the Broadcoms, NVIDIAs, Microns, even though there's been some volatility there, because, there's demand. It doesn't matter where it's going to go. They're going to get some business there.
Right. Right.
So one of the great things about working at the Wealth Consulting Group and with Jim is we have a diversity of thought culture. And so, like you said, differences are celebrated, not
Yes.
not squashed. So this is one of those times where Jim and I get to disagree publicly, and we've done it before, so no big surprise. But there's always, and this is part of our process, respectful argument and discussion and disagreement. But on the SpaceX front, so I penned kind of a think piece on that several weeks ago that got some good attention. But to your point, just talking about, and this is kind of to Jim's credit, and because you mentioned it, Hardika, I mean, SpaceX had a nice top line beat that was good to
Yes.
see. But you're right. I mean, in absolute sense, on the bottom line, yeah, they're running a loss, but even still, they came in with a nice beat. So the numbers weren't as bad as expected. They were better than expected. But my broad investment thesis about the space economy, and that was a fun little exercise for me as a financial economist, because I mean, it's like science fiction. It's so new, and I've never done anything like it. But my whole point was just be careful that you understand these timelines, which I think stretch far beyond our useful lives as human beings, at least until we solve that longevity problem. And just be sure that you're not overpaying. And I think
Yeah.
unfortunately, a lot of investors did end up overpaying. And so now we've done, I guess, more than a round trip, and I'm actually thinking about picking up some shares.
Well,
Interesting.
and going back to Talley's point, I mean, we view things a little bit differently. I view it as a position sizing, risk management. Certainly, with prices not knowing what the valuation is going to be, this is something that, again, thematically nibble on. It's a very small position, optionality. Sometimes these things work really, really great, right? If a 50 basis point position becomes 200 basis points, that adds value to the portfolio. But it's not going to kill your portfolio if it goes down. But yeah,
If you have 100-year time horizon, I think you're going to be fine.
Yeah. I mean, I think I might have that with how long people
Yeah,
are
you
living
do.
these days. You'll be there too. You'll be there too. No, that's very interesting to hear. And yeah, I think with SpaceX, when it first came to market, to be honest, my thoughts were very bearish. I didn't like the company at all. I thought it was just going to be honestly a dumpster fire. And then the share started going down so much, so fast. It was not surprising to me at all. But then I listened to the earnings call, and I think there's a reason for buying companies like SpaceX, and it's their moonshot ambitions. I mean, if you look across history, you have these great companies, right? You have Google, Meta, Netflix, and they had 30 different crazy ideas running around, and none of them were going to pan out potentially, but they just needed one of it to do really well, and that was all they needed to sort of like emerge as the top leader. In Google's case, it was their bet on data centers that played off. I mean, when they were looking at data centers, cloud wasn't even a thing. In Meta's case, they didn't have a mobile app, but then they expanded into it, and it became one of their biggest product. And they get most of their revenue earned from their family of apps on mobile. So I think there is something to be said about companies like SpaceX, as shaky as their performance might be in the first year and their fundamentals might be in the first few years. At the end of the day, these moonshot ambitions, I see a reason for why people would like to hold these companies. And another thing I kind of want to add as well is that Uber, I don't know if you've looked at the S1 recently, but when they had their S1, they were very focused on having futuristic goals like self-driving cars, flying cars, all sorts of things. And then they gave that up when they came to market. And now you see that their share price has severely underperformed the S&P 500 since their opening price. So I think if you can push through on these moonshot ambitions and sort of just let the haters stay in the background, it could pay off really well for the risk takers.
Yeah, I would agree to that, and I would say that sometimes these companies, they go through these cycles where they're really really beloved, and sometimes they go through these cycles where they're really really hated.
Hated.
And Tally knows this well because there's this kind of like contrarian look at it, and so sometimes it can be rewarding to buy things that they've already bought them. There's already capitulation. There's no more sellers. The next person coming in is a buyer. So sometimes those can work out well too.
Yeah, that's the main question that I'm wondering. What would be that turning point for SpaceX? And I just don't know what the timeline would be. Maybe it's 2030 when they launched no, they hit 1 trillion in revenue. So maybe it's that. But I just don't know. And that's the part where it's like, I don't know if this is a good buying time. But I think Tally disagrees with me on that. He's thinking of loading up.
Well, so not to complicate the conversation and muddy the waters, but and I've been asked by Bloomberg reporters this very, very question. So I think the conventional wisdom at one time that given this was before the IPO, given Tesla's relative fundamental health that has reversed since, it made more sense for Tesla to buy SpaceX to create the vertical. But now, despite the rollover in SpaceX, they've launched. It actually has a bit of a premium to Tesla. So I think that logic has kind of flipped on its head. So it might make more sense to use that M&A currency for SpaceX to buy Tesla. But now we have that added complication of all those SpaceX shares coming to market, and of course, if you apply kind of the simple or traditional logic of what happens to the acquirer's stock, there might, and I'm talking about SpaceX, you might have a little bit more kind of continued weakness until, and I'm just spitballing here. We don't know if that's going to actually happen, but that I would say is a reasonable kind of approach to a scenario. What do you think?
It's interesting though, because we did have a lot of shares come online, and what happened? The stock did well. So sometimes it's not what you think is going to happen. You think that, oh no, there's more supply, but I view that as very healthy. So we'll see. I mean, we still have the rest of the year and into next year, more unlocking, but I view that as healthy. So.
Yeah, that's my contrarian view too for SpaceX. Going back to things you never expect could very well happen. I also saw this reporting that it might be Tesla shareholders which own a majority of this new vertical that would be created with the merger or acquisition, I suppose. So
interesting.
Yeah, would it be worth buying Tesla at the premium then?
Well, if it's SpaceX that buys, so it was a merger of equals. Now it's going to be kind of target acquire. I think, we're still finding consensus on this. Yeah. That's why I'm kind of, throwing things up here to see what sticks. But so my logic there was if SpaceX buys Tesla would see the tactical balance, and SpaceX typically would see some weakness.
That's interesting. Yeah.
If they're the acquirer. But I wanted to, let's kind of, when in doubt, zoom out. We'll go back to our comfort zone. So out of the micro, back to the macro here. And we were talking about this before, and I think I know your answer. Some of the consensus views that you disagree with right here, and you think are wrong, and maybe that's as market expectations for Fed hikes are probably a little bit overdone, and that's probably because inflation's not as bad as everyone thinks. And I agree with you. I have a lot of economist friends, and let's face it, it's the dismal science, right? So they tend to worry too much about inflation and rate hikes and the economy, hell in a handbasket. But what are you seeing? What are you saying and talking about?
The biggest thing for me is the job market is extremely weak. And it's been weak for most of the year. And I think when we had a slate of those really strong reports, everybody started to have the view that the job market is hot. And I just simply disagreed with that. And the biggest reason why I think that even if jobs were to grow outside of this healthcare and social assistance and leisure sectors, even if you have a broad based job market growth, it will still not be hot until we see wage growth start to at least keep up with inflation. We don't have that so far. It's significantly below where inflation is. And I think that's why I'm not worried about an inflation spiral out of the job market anyway, because people just don't have that sort of commanding power over their employers right now to ask for higher wages. And once you get that higher wages, you start to see like this like inflation price spiral where higher wages propagate even more demand for goods and services. And then that cycle just continues on. And then they get more raises. And I think we just don't have that circumstance right now, which is why job market weakening is concerning to me. And another reason for why the Fed can hold right now, other than what's going on with inflation. Now, if you take a step back, I'd like to talk about the K-shaped economy again, because to me, it's one of the things you need to keep watching for any signs of breakage. You look at credit card delinquencies, you look at student debt, you look at car delinquencies. And I think across that, what we're seeing is that there's a very small segment of consumer that is getting pressured right now by this higher interest rate era. And I think that on the top income side, they haven't really been affected. In fact, they've thrived in this market. You look at prices for luxury hotels, they are very comfortable raising their prices because they continue to see demand. Delta Airlines, even though oil prices have come down from their highs of the year, they're not really looking to cut prices for tickets because people are willing to pay up. You have Delta Sky Lounge, which is just like amazing seats, and people are paying up for it because they aren't really getting hurt by this year's economy, this year's stock market. They're thriving in it. So I think for me, I'm really concerned about what's going to happen to this K-shaped economy. And I think we really need to watch whether the top income consumer breaks or not. And the break is only going to come if the stock market gets hurt because of the wealth effect. So that's one of the big things I'm watching this year.
So it sounds like you're saying bad labor market news is actually good market news.
Good for the Fed. Yes.
It keeps the Fed at bay. And I tend to agree with that view. But I'll give you the last word, Jim.
I would agree also. Oh, no, I was just going to ask, your comments about the K-shaped economy and unemployment. I'm not an economist, but I do look at, labor participation rate and things like that and demographics. It's just super fascinating to me.
Yes.
And they're like cash levels. We look at that too. So we went from $28.7 trillion in cash, not counting T-bills. This is just checking accounts, savings accounts, CDs, money market fund accounts, all of that. $700 billion came out of cash, right? And by the way, the interest on just the money market alone is like 300 billion. So if you're just sitting in T-bills, I mean, there's some money there. My question is, I guess, the demographics. What do you think is happening behind the surface? Because I feel like there's 100 million people that are not working, that are not looking for a job. So they're not counted in the unemployment figures. Some of those are retired. Some of those are related to people that have a lot of money, right? But then there's the people that are wealthy, that are older and they're aging and they're savers. They're not investing as much as they were. And so that kind of would be bad for the market, right? But like to the degree that they keep buying bonds, you would think that they would keep interest rates lower. I'm just curious what your thoughts are. Demographics, cash, what's happening under the hood?
Yeah, the labor market force participation rate has gone down according to the latest jobs report. And if you look at it, what we're really seeing is it's the 55 and plus group that's dropping out of the labor market. And we're not really sure what's going on there. It could be that AI is taking their jobs and they're just like, you know what, I've been in the labor market for 40 plus years. I'm good. I did my time. I'm
Yeah.
just going to retire right now while the stock market's at all-time highs. Or there could be something else bigger going on. We just don't know. And then there's a bigger concern about the accuracy of these jobs reports that we've seen lately because they've been so wrong. I think this year,
Yeah.
the average miss on the jobs report is on pace for the highest since 2022, which was very chaotic, by the way, if you all remember that. So that's just what stands out to me. But then if you go back to how the 55 and plus crowd is behaving, I think they've been really scarred by the incidents of the dot-com bubble, the '08 crisis. And I think when they see a stock market like this, where every single day the headline on CNBC is AI bubble, overvaluations, hyperscalers capex build out, 500 billion, 200 billion. These are just numbers being
A
thrown
hedge
around.
fund that blew up that was
Yes.
investing in AI.
Yeah, on his wedding weekend, by the way. So I think it just makes people scared. And that's why, even though the Wall Street Journal does this story almost every single month now about how the cash pile on the sidelines keeps growing bigger and bigger, and
Yeah.
Wall Street is salivating over when it's going to enter back into the stock market, you have not seen that story play out because people are scared. And I think we forget often how scary it is to be an investor, especially when you have so much, huge chunks of money just being thrown around towards building data centers, which no one is seeing a clear payoff for. Not the companies that are making these investments and consumers too. Yes, we have AI, but is it worth justifying trillions of dollars in capex? I don't know. I'm not so sold on that part. I think that's why we haven't really seen this cash move from the sidelines into the market. And I just don't think that's going to play out right now, especially when yields are this high. I think last year the expectation was that yields are going to come down, so lock in the CD prices now, but it's just going to be higher for longer.
Do you think the wealth transfer of some of that money to like the children and the grandchildren that gets spent, or maybe it gets invested in other areas? Maybe too much goes into crypto. I like at some point, you know,
So-
you're going to have more transfer of wealth, right?
And women are supposed to be the biggest beneficiaries of that. And I think that's why wealth advisors and financial advisors, they all really need to focus on women right now,
Yeah.
because not only are they the ones stepping up right now to help out their older family members, but also because there is a financial incentive to it. At the same time, you want to make sure that they're empowered to make these decisions when the time comes. And it helps to have those relationships built early on.
Hardika, I was going to say, I was laughing earlier because you were talking about the 55 and older crowd. This is a couple years. And we'll
Talley and I are
know
getting
what
closer to that,
cohort
aren't
is
we?
thinking.
Yeah, I mean, I want to retire. That'd be great. I'm kidding. I like working.
So anyway, I wanted to give you a chance to kind of take the mic, take the floor, and what, in your own words, what's the number one or top few reasons why investors should keep their eye on the prize here and stay bullish and stay involved in these markets?
I think if you have a long-term investment horizon, if you're not in the 55 and above crowd and looking to retire this year, I think it pays off to buy all these dips. In a way, it's a self-fulfilling prophecy, right? You have had these past 5 years where we've had incredible violent moves in the market, and still they've been very quick to recover. The dips have been buyable, and everybody knows that now. So everyone's going to follow the same playbook where they're going to see a huge decline, they're going to swoop in and buy it. Look at what happened with SpaceX, right? When the shares came to market after the first lockup expired, shares went up. So I think that investors have been very trained over the past 5 years to just buy the dip. And I think if you have a long-term investing horizon, there is no reason why you shouldn't buy the dip right now. Even if you have a small dip or a big dip, you should just keep investing and stay on the path.
Well said. Well, thank you so much. This has been great. And hopefully we'll have you back on the show before Jim and I reach 55.
Whenever we reach the 55. Thanks so much for joining us, Hardika. It's been great.
Thanks so much for having me. It was so much fun.
Hers and his, three's company too. Come and dance on our floor.